Hey, this is Jesse, 50% of Broker Banner. I am here alone without my partner in crime, mainly because he's disgruntled that I have a better mustache than him, but that's neither here nor there. Thought we'd do something a little bit different this week. I actually got my start not in commercial real estate on the brokerage side, but actually in investing in student housing and then in apartments. If you're interested at all in that story, I'll put a link to a Bigger Pockets podcast I did last year. I think there's a common thread in terms of the typical mistakes investors make, whether you're a seasoned vet or it's your first rental property. So want to go over a few of them. Hopefully you find them helpful. So this is just one kind of, as a broker, you see so much is it's incorrect language. Whether you are starting out or you have been doing this for a long time, language is so important when it comes to our industry. And in terms of credibility, and whether you're trying to syndicate a deal for 200 units of apartments or you're getting your first student rental property, you really need to know the language. You know, I've heard pretty much everything in the industry that you can think of incorrect language. You know, you'd have guys go net operating income minus debt service, i.e. cash flow. You know, there's things that you'll hear said in this industry that immediately you can tell the person doesn't really know what they're doing. So it's so important that if you're going to speak confidently about real estate, you really need to understand the language, the acronyms, and trust me, I understand we have way too many of them in our industry, but at least knowing what they mean and not using made up ones will get you a long way when it comes to your first couple properties and beyond that. This one, beginning investors, it's understandable why the look of a property initially can turn somebody off, but time and time again, you'll get investors that'll look at a property that doesn't look great aesthetically, but that doesn't have anything wrong with it from a structural point of view, and has a great cash flow, and they shy away from it. And that's natural. When we go to buy our houses, we want it to look pretty, we want it to feel good about purchasing. But what you have to look at multi-residential and commercial real estate, or investing in general, that the value of your property is determined by the cash flow, by the amount that it actually produces. Now that production might be correlated with the look. So for instance, a AAA apartment in Miami, that's gonna have something to do with how nice the place looks. Whereas perhaps an industrial facility outside of Chicago won't. So you really have to look at the numbers and look at what actually needs work, and don't rely so much on just the aesthetics. People come into investing and they look at a metric called cash on cash return. It is probably one of the most popular that you will hear somebody when they are purchasing a property or just purchase a property. It is not a terrible metric, but it is way too often overused, even by sophisticated investors. So simply put, if you put $100,000 of your own cash into a property and the return was $50,000, that is a 50% return on your money that you've put in the deal. Why is this not the best metric? It's not the best metric because it completely ignores the time value of money. And the time value of money is absolutely critical when it comes to not just finance, but specifically real estate finance. And I'll try to explain a little bit about that by explaining the NPV first, which is net present value. And I know there's eyes glazing over just by saying that, but that's simply all of the cash inflows from the property versus all of the cash outflows. You subtract those, you bring them to today's value. And if it's positive, you have a positive NPV, and if it's negative, you have a negative NPV. What the IRR does, mathematically, whatever the NPV of a project is, it sets it to 0. And by setting it to 0, if you do the math, you spit out a percentage. Now you don't need to get into a lot of the background financial implications and the mathematical implications. What you just need to know as an investor is if you do have a positive IRR, that's good, number one. If your IRR is larger than your cost of capital, your cost of borrowing, so for a company, you know, say that's 5%, but the return on this project is 10%, it's a go, no-go type of decision. And in that case, it would be a go. Now the IRR is more complicated than that. Sometimes there are multiple, sometimes they are negative, and there are some inherent issues with that metric. So I'll put a link down so you can kind of get a little bit more of a full picture. And if anybody's interested in me doing a video specifically on the internal rate of return, I'd be more than happy. I think the takeaway here is that the IRR, it's a superior metric, and cash on cash return is okay, but just understand that it is not taking into account that crucial time value of money. Big exit strategy. Exit strategy, that buzzword, just to understand why you are buying the property and what is the anticipated disposition of the property. Or do you anticipate on disposing it? In Canada, we have a very buy and hold type of culture when it comes to properties. That's changing more now. We're starting to see more velocity in the market. Our neighbors to the south, they do have a couple more options rather than just selling and then having a tax event. In the States, you can do things such as a 1031 exchange, which is a like-in-kind asset tax deferral strategy. And I'll put a link to that because it's, even if you're Canadian, it's good to actually look into what that is exactly. But bottom line is, you have to buy a property and not be so short-sighted. You have to understand, or at least have an idea of what your intention is with the property down the line. And maybe if it's even before disposition, am I going to refinance it in 5 years, 10 years? What do I intend to do? What kind of market would I be selling it if I do intend to do that? So these are all things that you should be thinking about at the time of purchase as best that you can. Because at the end of the day, we're humans. It's not typical for us to look 10, 20, 30 years down the line with complete accuracy. Capital expenditure reserve, AKA CapEx reserve. This might be one of the most overlooked line items when it comes to investing. It's so overlooked that there's a debate whether it should be going in the net operating income, above the line, or below the line. It should be stripped out. This is one of those things that when we have a family living in our house, we put away, or should put away, some money for things that are just going to go wrong. A roof goes, HVAC goes. Now, we put that money away so that it builds up, that when that thing happens, we can afford it. In the same way, when it comes to real estate investing, you cannot expense all in 1 year some major event that happens, some major, say the roof goes. So you have a large issue and say it's a commercial roof, say it's $25,000. That's not all gonna be expensed in 1 year. That will be smoothed out or amortized over a number of years. But if you, say, bought a property and the roof's new, then you go, okay, I don't have that expense. You don't have that expense right now, but say in theory 20 years from now you will. You need to be putting a little bit of money away each year, and that money is slowly going to build up to that when the roof goes, you expense it. And that's simply what the CapEx reserve is. So it's a line item that we put down in our analysis of properties. In the same way, we put down something called repair and maintenance, but this has to be understood that it's slightly different. One is, like it says, for repair, and one is for the maintenance of equipment. The other one is the actual capital expenditure, when the thing goes, when the HVAC system is done its useful life, and when the windows are need to be completely redone. And that's why the CapEx is a crucial element from an investor standpoint. Ultimately, we're dealing with properties. There are certain elements of properties that will break down and others that will completely go. So they're not pieces of paper, and we definitely need to keep that in mind as investors. Okay, I hope that was helpful. If it's of interest to you, I'd be more than happy to explain some of these elements in further detail, and have a great week.